Hey guys, my name is Austin. I'm a mortgage agent with the Buying Group. Also have Tyler and Kyle back there. I'm going to talk about some of the predictions in 2026 from both a financing point of view, mortgages, and also from a real estate general point of view. One of the big things I want to talk about is to understand where we're going to go forward. We need to understand what has already happened, right? So since 2024, we saw the Bank of Canada cut their overnight rate from 5% to 2.25%. Okay. So obviously we already seen, sorry for that. Is this two? Perfect. Yeah. So we're already seeing some significant rate cuts. Put things in perspective. Earlier in the year, a lot of variable rates were in the fives, high fours. Nowadays, you're seeing variable rates in the high threes, low fours. If you have insured mortgages, it's in the mid threes, right? So some pretty drastic changes in the mortgage environment. From a fixed rate point of view, early in the year, we're seeing things in the mid fives to low fives. If you're lucky, high fours. Nowadays, you're seeing fixed rates in the threes to the fours. So over 100 basis points off across the board when it comes to mortgages. 2026, it's a rate predictions. We're going to look at it from two angles. The first one is what are financial markets pricing in? And the second one are what are the banks pricing in? Because they're two separate sort of opinions. Okay? Financial markets are pricing in no rate cuts going into the new year, right? But also no rate hikes as well. So rates are more or less going to be flat from the Bank of Canada. Should it be a surprise? In the last Bank of Canada meeting, they also said that rates are going to be at its sufficient level, assuming their economic projections sort of pan out, right? So if things get a lot worse, then it's potentially we might see some rate cuts, but if the market's right, then things are going to be more or less flat. Now let's talk about the big banks because the banks differ a lot in their opinion. Three of the six banks assume that rates are going to more or less hold into 2026, aligned with financial markets. Two of the six banks believe that rates are going to cut once more in the first quarter of 2026. And Scotiabank, the loan bank, believes that rates might actually hike two times in the last quarter of 2026. General consensus is that rates are more or less going to stay the same. The data and the thought process behind each sort of prediction is in terms of rate cuts, it's straightforward. If there's continuous economic deterioration, the labor market continues to soften, if inflation continues to soften, we might see some rate cuts. In terms of the argument for rate hikes that Scotiabank has made, they believe that inflation is a little bit stickier than projected, partially because inflation, which strips out the volatile components of headline inflation, it's still close to the 3% range. Okay. So that's why Scotia sort of believes that rates might be a little bit higher in the latter half of the year. Also, on top of that, they believe that the past couple of rate cuts were like an insurance policy. We didn't really need to cut the rates, but they did it just in case, that tariffs had a bigger impact on the economy. So pretty varying point of views, but general consensus across the board, traders and and banks is that rates are more or less going to stay the same. Okay. Outside of that, in terms of fixed rates, because we focus a lot on what the Bank of Canada is going to say and what they're going to do, right? That impacts the variable rates. Fixed rates are a little bit different. Fixed rates are dependent on what's called bond yields. Okay, raise of hands if you guys heard the term bond yield before. Awesome. So a lot of you guys, but just to reiterate, so essentially what a bond yield is, it's the rate that the government of Canada pays to borrow money because the government needs to borrow money as well, right? And it's considered the risk-free rate of return, meaning that banks have money, they can loan it to you and I in the form of mortgages. They can also loan the money to the government. The government is less riskier than a consumer because the government can always just print money to pay off debt. We cannot. So if the 5-year bond yields increase, generally speaking, you're going to see fixed rates increase as well. So what happened in terms of 5-year bond yields over the past year is that it's been extraordinarily volatile, but generally speaking, the trend has been coming down, which is why we saw fixed rates sort of relief, right? That being said, the past 3 months, it's been going up, it's been going down. Every single data point just drives it wild, which is not normal for something like bonds. It should be a stable asset, right? But it just goes to show how crazy times that we're in, like what crazy times we're in. Generally speaking, in terms of fixed rate, there's no consensus, right? Like I know that everyone wants a projection. It's sort of split between. If the economy continues to deteriorate, we may see a little bit of a read in terms of yield, right? If things sort of largely play out as, expectations in terms of like economist expectations, we may see fixed rates, give or take, just stay the same as they are, right? So general takeaway is that there might be a little bit more rate relief, possibly, but it's not guaranteed, right? More or less things are going to stay stable. So made that up a point earlier that rates have sufficiently come down, right? Like even if the Bank of Canada cuts 25 basis points, is it going to materially stoke demand? A lot of it is down to consumer confidence, right? And the data sort of reflects that, right? Consumer confidence at the moment is at an all-time low. We're talking about lower than the pandemic when people thought the world was literally going to end, lower than the global financial crisis, lower than the 80s, lower than the 90s, right? So obviously, consumers are scared. Maybe it's like tariffs for their jobs, wherever the reason is. No amount of rate cuts is necessarily going to replace that. I think we're going to need to see some sort of stability or alternatively time, right? Time just heals everything. You know, if you give things enough time, people realize it's the new normal. If they have to buy, they'll go ahead and buy. Okay. One of the other big things that I wanted to touch on, and I agree a lot with what Ming said in terms of like 2026, I think things, in the personal opinion, are gonna slowly recover. Nothing's gonna be what you saw in 2021, 2022. That was nuts, right? But we are expected, or at least I believe that we're gonna see a recovery, partially because, when we look at supply at the moment, it may be considered well supplied in today's market because people are just not actively buying. Generally speaking, though, our months of inventory is still relatively low, right? Especially with single family inventory, right? A freehold inventory. Currents in Ontario at a 3-decade low. Just think about it. Who's going to build a single family home and sell it? Crazy. Right? People are going to build condominiums. That's where the money goes into, right? And on top of that, with all of these recent sort of financing programs, MLI Select, which encourages people to take single families off the market and convert them to 5-6 units, that is further stripping out an already very scarce asset in Ontario, right? When you strip out, with a scarce asset and you continue to strip out supply, and there's going to be no future supply to replace it, the data is clearly showing that as well. It's only a matter of time until there's a recovery, right? If the recovery doesn't need to be a massive boom all in one go, but when people gain confidence again, they're going to slowly enter back into the market. Last thing I want to touch on is there was, the Liberals announced their budget. One of the key takeaways that's a pretty important focus for investors is this population growth. And the budget pretty much admitted that they screwed up immigration. They let a lot more people in the country than they should have, and they're going to try to reverse that. Cut down the targets for non-permanent residents in half, right? So what I've been hearing is some investors are a little bit worried about that in terms of the housing prices. But you do need to keep in mind, right, that the non-permanent residents are not necessarily your buyers. They impact rental market. So that is true, right? Your buyers, your end consumers, the people who are going to buy the properties are your permanent residents. That's the data you need to take a look at, right? Regardless of the cuts in non-permanent residents, permanent residents data shows that the projections is that it's going to stay the same from the pandemic level going forward, which is about 385,000 people a year. So your demand, your home buyers are still there. They're not gone. Yes, they're a little bit worried, but that ultimately says to me it's pent-up demand, right? Slowly, the release valve will come out. We don't know when that's going to be, but it's sort of this perfect little storm. But that's my thoughts.